I'm Pat Harker, President and CEO of the Philadelphia Fed. So we are absolutely thrilled today to host a chat with Brian Brooks, the acting Comptroller of the United States. So let me just hop right in. We have a little bit of time. We want to leave some Q&A. And so, Brian, again, thank you so much for joining us and sharing your perspective on banking and fintech. So you've been acting Comptroller for just 6 months and arrived at a very challenging time. So let's just start off with a personal question. What's it been like? I mean, is it what you expected? What did you expect?
Well, Pat, first of all, thanks so much for having me, and I hope that next year we can actually do this in Philadelphia. This whole 6 to 9 months of everything being virtual is absolutely bonkers. On what I expected, I'll tell you, the whole story of my life is the idea of setting low expectations and exceeding them. So I think that's exactly what has happened here. Is I walked into the job in the middle of a pandemic, on the verge of some historic social justice protests, and one of the most hotly contested presidential elections of all time. What's not to like about that? And it's been a really interesting leadership lesson of, we have a lot of urgent things to deal with, but we also have a lot of long-term important things to deal with, and we've tried to not let the urgent overtake the important. That I think is the lesson of the last 6 months.
Wow, yeah, that's a big lesson. So let's hop a little bit into banking and your thoughts. So you said that banking's at an inflection, and it's being shaped by two forces, right? Unbundling and decentralization. So what do those terms actually mean to you? And how do you see them changing banking?
Well, so these are related but different, and let me see if I can unpack them both for everybody who's watching at home. The concept of unbundling in banking is that historically people thought of banks as organizations that did three functions altogether. They were deposit takers who made loans and engaged in payments. And the thinking, in the 15th, 16th, 17th century, when that idea was starting to develop, was that you couldn't really do one without the other, right? You needed stable, low-cost deposits in order to make loans and make money based on the interest differential between the deposits and the loans. You had to have deposits in order to engage in payments, because it was the deposit account from which you debited the payment to remit to whoever the recipient was. And so the thinking was you really needed those things to be together. Over the last 30 years, a couple of different forces have taken shape that have really disrupted those assumptions. So one of them in the 80s was the development of capital markets that compete with banks as a source of funding, right? So in the early 80s, when the first, mortgage-backed securities were invented, when early, debenture markets were formed and everything else, a lot of people debated in those days whether we even still needed banks, because I didn't need to go to a loan officer for a loan. I could just float a debenture in the market. So you had market forces. But now you also have powerful technology forces that allow banks to crowdsource funding. They can engage in peer-to-peer lending funded by other customers on the other side of an internet connection. And so the whole set of technology and capital markets evolution mean that the old model of a bank may not be as attractive anymore. And that's playing out in two different ways. So one is, a lot of these fintech companies are offering such specialized customer experiences that customers who want to borrow a student loan just turn out to like SoFi better than they like the bank down the street, because it's a bespoke experience just for them. There's a lot of consumer preference being revealed here. But there's also a lot of investor pressure, which you just see in the data. I mean, one piece of data that I looked at just a few weeks ago tells us that over the last 3-year period, the average price-to-earnings multiple that large banks were receiving was around 15 times earnings. But the price-to-earnings multiple that the most successful fintechs were making in similar activities was 50 times earnings. And so you can see there's a huge pressure, if I'm an investor, to say I'd rather invest in the specialty payments company than in the big bank. If that's the case, you can expect over time that the big banks will start shedding non-core businesses in favor of fintechs, at which point I have to ask the question as a bank regulator, how am I going to preserve safety and soundness of these activities if they're all flowing out of the traditional banking system? And the most obvious answer is we need to reconceive what a bank is in this country. So that's what unbundling is about. Decentralization is a little bit different, but I think it's equally easy to understand. And that is, if you just think back to the days of centralized information exchange. I mean, not everybody on this video is old enough to remember it, Pat, but you and I both are, where if you wanted to communicate with somebody far away, you had to write them a letter. You'd send it to the post office would aggregate all the letters that came in on a given day, and then farm them out on trucks to all of the locations that they had to go to. The problem is if the trucks broke down, if there was a lot of bad weather or whatever, the letters couldn't go anywhere, right? Centralized command systems are inherently vulnerable to the single point of failure problem. Bad snowstorm at the New York Central Post Office, and there wouldn't be mail in the Northeast for a week. Along comes networks, right? The internet doesn't go down because the internet is a network consisting of millions of nodes. It's all the computers that are plugged into the internet, and half the nodes can go down, and the system still works the same as it did when they were all up, right? It's more resilient, it's faster, it's cheaper. That's what decentralization means in finance, is right now we operate a relatively centralized system of a few thousand banks, one Federal Reserve, small number of payment systems that are all vulnerable to the single point of failure problem. But networks are now arising, principally built on blockchain, but there will be quantum computing and other kinds of network effects that don't have that problem. So if you kind of like your email better than writing a letter to somebody, you're probably going to like a future that is decentralized. And that desire and preference based on internal stability advantages is likely to win the day. Not tomorrow, not next year, but in the next 10 to 15 years. And so one of my messages on decentralization is we need to demystify blockchain and crypto and other decentralized structures. We need to make it safe for the world, and we need to show banks what their role is in that future economy.
They're very interesting. Let's follow up then on the emerging players, the new players coming into the market. So you're on record as stating the OCC is considering issuing national bank charters to companies focused on payments, for example. Why is it necessary? Why is it necessary when BPI, for example, has a real-time payments project? The Fed is promising a system by 2024, and companies like Stripe, Square, PayPal seem capable of developing and offering payment solutions and services. How would issuing national bank charters for a payments company benefit consumers and improve the system we have? How does that fit in to the unbundling and the decentralization that you're talking about?
Well, so let me take you back 25 years in time to kind of give you an analogy to how I would answer that question. So 25 years from now, college kids and a few other like techno jockeys were starting to get these things called email accounts. They were clunky, they were kind of weird, and what people said at the time was, well, what do we need email for? We got fax machines. If you need real-time communication, it's no problem. There's a fax machine down the hall, and it will transmit the fax in real time instantaneously. Now, true, the other guy's fax machine might run out of paper. That's a problem. True, these things degrade over time, and they still have to be put in a file cabinet and everything, but it's real time, right? It's pretty good. That's kind of like embedded in your question what we're facing today. So when people say, why do we need a faster payments or a bank charter for a payments company when the Fed's going to give us real-time payments in 4 years? I just sort of stop there. Let's just let that sink in. So in 4 years, the Fed's going to give us real-time payments. Okay, everybody get the joke? They already have real-time payments in the UK and Singapore and China. And in the US, if we have the government build real-time payments, it's 4 years away, which, by the way, in Washington speak is code for never, right? If somebody's promising something in this town in 4 years, what they really mean is it'll be after I'm out of office, so it's not my problem. My concern is that there are technologies that exist today that allow for faster payments to occur. And the problem that makes it harder for some companies to build that technology, you mentioned the Stripes and PayPals of the world, is because outside of a bank charter, the only way for them to legally operate in this country is through a series of state-by-state licenses in multiple states that frankly have different and incompatible legal requirements. So the idea that in a given state, one of these money transmitters has no capital requirement, and in a different state, they have a heavy capital requirement. Or in one state, they have to have a certain kind of board of directors, but in a different state, it has to be a different kind of board of directors. That makes no sense for global companies that are remitting billions of dollars of payments a day. And the whole point of the National Bank Charter was to create the possibility of a single unified U.S. economy. So there are two issues here. There's, do we want faster payments? And if we do, the answer to that is we need to unleash the private sector on the problem. But the other question is, why do they have to have a bank charter? And the answer is, that's the only national license that exists. And so unless you think that a 50-state sort of balkanized regulatory structure is better, something that makes it harder and slower for those companies to go to markets, then you'd want a national platform, and ours is the only one on offer.
All right, well, let's follow up on that. The OCC is still appealing the decision blocking the issuance of these charters to non-depository fintechs engaged in this business of banking. What's the status? Just first, what's the status of the litigation? And how has that affected your thinking, and how does it affect your ability to charter companies engaged in payments?
Well, let me answer that question, Pat, in two different ways. So first of all, I'll just say that there's a mistaken assumption that some critics have, which is that the only way a payments company wants a bank charter is to be a non-depository. The truth is we have a number of payments-related companies coming into the OCC for other kinds of charters. So, for example, a number of crypto companies offer their services through state trust companies, and they've now approached us about converting to a national trust bank. Those are statutory bank charters that don't have any litigation issue. There's no legal question about them at all. But we have several applicants in the door for those types of charters right now. We also just recently chartered a new bank called Chico, which is a really innovative technology-driven payments firm that just bought a small bank in Minnesota so that they would avoid that problem. Now, you could argue it's kind of stupid for a payments platform to have to go through the rigmarole of buying $100 million thrift in Minnesota so that they can conduct their business. But, some people will avoid the legal issues that way. On the core legal issue you're asking about, let me just start by saying my mentor in the law was Bill Coleman, who was sort of the main architect, with Thurgood Marshall of the Brown versus Board of Education appeal. And one story Bill told me many times is they lost in the district court, just like we lost in the district court, right? The NAACP lost the Brown case. That didn't stop them from appealing. They were convinced that their legal analysis was correct. And in the end, in the Supreme Court, they prevailed. We feel the same way about this. The fact that there is one district judge that came to a result can't be, in our federal system, the end of the issue. So we think we're going to win for a variety of reasons. One is all of the precedent in history shows that whenever the OCC changed the concept of banking in a given generation, there was always controversy, the states always litigated it, and the OCC always won. They always won because our statute was designed in the Lincoln administration to be flexible, to allow us to adapt the concept of banking to that generation. So just to give you a couple of examples, in 1870, the OCC had to take to the U.S. Supreme Court a case about whether it was within the OCC's power to allow banks to issue certified checks. That was super controversial in the Reconstruction era, and we had to go to the Supreme Court to win that case. You fast forward to the 1960s, banks had gotten computerized and they wanted to sell their excess data processing capacity to customers. That was challenged by all kinds of trade associations and the states. OCC won that case. Fast forward to the 1990s, variable annuities are a big thing to allow banks to give people securities like returns inside of a deposit product. No way, said the states, and the OCC won in the Supreme Court. So this is not, there's a regulatory competition that goes on. It's kind of natural and healthy. We have a dual banking system in this country, which the OCC supports, but our belief is that the states can charter these companies, so can the OCC, and that's what our statute says. So I think we're going to win this case, as we always have before. There will be setbacks along the way, and that's okay. That's the nature of our system.
Okay, good. So on the day you became acting comptroller, the first policy action you took was to sign the agency's valid when made rule. About a month later, you proposed a companion rule to address true lender issues. Community groups and state AGs have said these actions will result in consumer harm by giving payday lenders a toehold into banking in a way around state usury law. You obviously have a different view. What's your response? How do these rules intersect with what's happening in Fintech today?
Well, first of all, with the valid when made rule standing alone, Pat, we didn't see that as particularly revolutionary. We saw that as restoring the law that had prevailed in this country for 100 years before the Madden case in the Second Circuit came out just a few years ago. And our economics group have looked at the Madden case and its aftermath in New York and the other states of the Second Circuit to see what happened to consumer lending in the wake of Madden. And again, I don't want to presume that everybody on this call knows what Madden is. Maybe I should explain it for a moment. Madden was a decision which said that when a bank makes a loan using its interest rate exportation powers, in other words, if a bank in South Dakota where there is no usury cap lends into New York where there is a usury cap, the national bank, or frankly any bank, can do that. And New York's usury laws don't apply to that loan. So I can make you a 5% loan in New York, even if that exceeds usury and it's legal. What Madden said was somehow if the bank then sells that loan to an investor, that previously legal loan term becomes illegal because the investor is not itself a national bank. Here's what that's kind of like. It's sort of like if you agree to pay rent to your landlord of $1,000 a month and then the building gets sold. somehow your $1,000 a month obligation goes away and it's now illegal. That's crazy, right? You signed a contract to pay a certain amount of money. It was valid at the time you made it. And no matter if the landlord sells the building or doesn't, the rent is the rent, right? And markets depend on that. So what we found when Madden came out, and it said that these secondary market loan sales were in fact illegal, is we found that lending to low and moderate income consumers fell by 64%. In fact, the U.S. Court of Appeals for the Ninth Circuit, which just looked at our rule just a few weeks ago, cited that statistic in its decision, a 64% reduction in credit availability for poor people. Now, advocates will tell you it'd be better that poor people don't get loans at all than that they get loans at a rate higher than usual. That's nice to say if you're an elite 1%er who gets the prime rate and always gets the good deal, and it makes you feel kind of icky that anybody else doesn't. But our philosophy of economic growth at the OCC is that if you want to climb the ladder, there need to be some bottom rungs on it, right? People have to be able to get on the ladder and start climbing. And if you have a low FICO score or a low income or fewer assets, it's still important in this country that you have access to capital and credit to start your business or go to college or whatever. So we frankly think that rule is kind of elitist, the Madden rule, and our point was to restore the law that's been around a long time. Now, the problem was that with our valid when made rule, we made clear that a loan a bank made is legal even when it's sold. But there remained the legal question of, did the bank really make it, or was the bank kind of like renting out its charter but not really involved in the loan? How do you know when the bank really was involved? And so we did two things in the true lender rule. One is we just said very simply, listen, if the bank's name's on the note, if the bank held itself out as the lender, it's the lender. End of story. But what we also said, and this is the part that the advocates have kind of ignored, is if the bank's name's on the note, it's accountable. Okay? If there was a fair lending violation, if there was a disclosure violation, if there was an unfair practice in the origination of the loan, we now know who to go after. And I think everybody knows from our recent orders involving, a number of big banks, we're not kidding around when we say we're going to go and police consumer protection. So the whole issue with True Lender was both to make the world clearer for secondary markets, but also to make clear who owes the consumer protection obligation. And the answer is it's the bank.
Good. So one of the other topics that before we get a couple more questions before we get to questions, and I encourage people online to please submit questions via Slido. We talked, my colleague, President Mester, talked a little bit about cryptocurrency. We're going to talk about that more later in the conference. Let's turn to that. You recently issued a letter clarifying bank's authority to provide custody service for customers' crypto assets. Where do you see crypto in the federal banking system? And what are the next big steps?
Well, so a couple of thoughts on that. First of all, there are two main obvious entry points for banks into crypto as that market currently exists. So one is custody, as you say. There's a lot more people who hold crypto assets in this country than is commonly understood. And most of those people, rely for their other financial assets on bank security, whether it's deposits in a deposit account or, things that are held in a safe deposit box or financial assets held in a custodian. And so whether you own Bitcoin or whatever, the idea that you can't rely on the safety and security of a national bank custodian is a problem for the system. So the point of our first letter was to open that up for all crypto assets that need custody. The second most obvious place banks are going to intersect this is in terms of what are called stablecoins. And stablecoins are essentially an internet native payment system. You might think of them as like a traveler's check or like a, some other kind of a payments order to a bank, except that they don't require any human processing. They transact directly peer-to-peer on a blockchain. And because banks are the core, nodes in the existing payment system, we came out with guidance talking about stablecoin networks as a version of a payment system. And as part of their payments activity, banks are allowed to hold the reserve deposits that back these stablecoin projects. The things that remain to be talked about and that we expect to issue some guidance on, in the future are, can banks connect directly to blockchains for purposes of remitting these networks, or can they only hold the deposits? Can banks create their own coins? I think most people will know that JP Morgan has their own private blockchain and have their own coin for these purposes. But could a bank connect to a public blockchain and issue a stablecoin as a payments remittance instrument? And then you get to the more interesting questions of, do banks have a role with respect to other cryptocurrencies? We get this question a lot from a lot of our members. We haven't reached a conclusion yet, but the kinds of issues you've looked at are, Are crypto assets meaningfully different from foreign exchange? You have volatile foreign exchange assets like, Malaysian ringgits in the 90s, Thai bahts, and other kinds of things. Banks have the statutory power to deal in those forms of non-U.S. issued currency. Does that same authority to deal in non-U.S. issued currency apply to cryptocurrencies? These are difficult questions, but with 60 million Americans in this market, we probably need to say something about that. At the end of the day, though, Pat, our whole thesis around crypto, and the reason it's important to understand is all of these tokens exist for only one reason, and that is to power the decentralized networks for value exchange. The networks themselves are clearly valuable. They have advantages over the central command structures we have today. And, while we don't endorse or not endorse an individual cryptocurrency as a good investment, these network effects are things we have to take seriously, and that's what we think we're trying to incubate.
Yeah, thank you. Let me pivot two more questions before we open it up. Let me talk about financial inclusion, which is obviously a big focus for us, the Fed, and for you. In May, the OCC finalized its rule to improve the CRA framework for the federal banking system. And in September, the Federal Reserve System released an ANPR beginning its formal rulemaking process. How do you see the OCC rule improving access to credit and capital in communities that the banks serve? And do you see a downside to having a competing regulatory regime? What's the likelihood? And I think this is really the question I know every banker is asking me. What's the likelihood of harmonizing these rules in the future?
Well, so I really appreciate the question. I mean, this is probably the most important work the OCC's done in the last 3 or 4 years is the CRA improvement. So I guess I begin by, I'm going to tussle with your hypothetical a little bit, okay? So you began the question by saying we released our rule in May, and then the Fed began its process on CRA in September. The truth is the Fed began its CRA work with us 2.5 years ago.
Oh, yeah.
Right? So there was a joint ANPR. All 3 agencies went out and figured this out. The way I see things proceeding from here is, first of all, I was somewhat worried about a separate ANPR coming out of a sister agency, but I spent a lot of time talking about that with Governor Brainerd, who gave me a lot of briefing up front about what they were going to do, and I think we had a real understanding that her work on this was going to be valuable. And I was gratified to see when the ANPR came out that it was very, very similar to our final rule. Not identical, mind you, but similar in most important ways. It focused on the same kinds of unaddressed communities as before. So, for example, the old CRA was heavily focused on urban areas, and their new ANPR, like our final rule, focuses on Indian country and small and family farms and, a series of other areas that was essentially excluded from the old rule. So that's terrific work on the Fed's part. And it also focused on changing the way that geographies are assessed. So what I say in every speech on CRA is CRA made sense at a time when people went to the bank, The idea was you gathered your deposits at a brick and mortar branch location, and it was only fair that you have to reinvest some of that money in the area around the branch where you gathered deposits. But in the last 20 years, when banks have pulled 10,000 or more branches out of poor neighborhoods, they mostly now solicit deposits in those neighborhoods over the internet or in some other way. The question is, how do you make it so the banks still have to invest where their customers live, even if they don't have branches? That's a pretty simple idea. But in a world of mobile banking and ATMs, it matters. And the Fed's rule adopts our position on that as well. It uncouples the obligations from the bank branches, which is terrific. The main disagreement at this point, Pat, is we think that the scoring for CRA ought to be more objective and less discretionary. And the Fed's ANPR envisions more of ongoing subjectivity and discretion in the process. Now, there may be arguments on both sides. To be honest, I don't know what the good arguments are in favor of more subjective versus less. But I always say we would like our CRA test to be more like a math test and less like an English test. We'd like banks and the public to know when a bank has achieved its obligations and when it hasn't. And there shouldn't be a lot of debate about that in the recent years. So other than that, look, I think they're going to learn a lot from their comment process. If good ideas come out, we are not above revising our rule next year to be better even than it is today. But I don't want to wait another 2 years to get a rule out because the status quo wasn't working. The Fed's ANPR recognizes it wasn't working. And our rule is better than the status quo. And if their rule is even better than ours, we will learn from that and make changes.
Thank you. I really appreciate your answer. The last question before I turn to the questions from the folks online. So obviously, this spring and summer, we saw an outbreak of protests against racism and social injustice. What do you take away from that moment? And is there a role for regulators, all of us, and the banks to help fix what we've seen is broken in our society?
That's the most important question anybody could ask, I think, at this moment. And so I would just say, when you see the protests coming down the street, you can have one of two basic reactions. You can either say, my God, the system has failed us and we need to throw out the system and start over. I'm not sure what you start over with. You could start over with socialism. You could start out with government allocation of resources or whatever, but you throw the system. Or if you're from my point of view, you could say, gosh, the system has been amazingly strong for me. It's been amazingly strong for about 80% of the country, actually, in terms of raising people out of poverty, creating a ladder of opportunity, making a dynamic, innovative economy where people can take risks and fail and start over, But somehow 20 or 25% of the country hasn't been included in that, and you can just treat that as a problem to solve. And so that's why the OCC started Project REACH back then. Project REACH is a consortium of banks and civil rights groups and tech companies and other stakeholders, where the focus is, let's find why these barriers are there, and let's just fix them, okay? Because the barriers aren't there because we're racist, but they're there because we haven't thought hard enough about the impact that some of these things have on minorities and immigrants and other people who are less fortunate. And so we focus on barriers like the requirement of credit scores. There's nothing racist about a credit score. A credit score is designed to predict whether you're going to repay your loan or not. But the way we build credit scores in this country excludes people who pay rent rather than mortgages, because you don't get credit on a credit score for timely rent payments. Excludes people who have recurring income in their bank account but doesn't get tracked in official models, et cetera. I mean, Pat, these things can be fixed. It's not the system is bad. The system can be made better. And we can save capitalism for another generation on the theory that capitalism brings more people out of poverty than any other thing in human history. But if we don't get to the business of including everybody in it, it's at risk of being torn out root and branch. I can't let that happen on my watch. I know you don't want that either. So our point is, we can build an inclusive capitalism that's meaningfully inclusive, but also meaningfully capitalist. And that's what we're trying to do in Project REACH.
Well, thank you. Thank you for that answer. So let me turn to the first question from those online. So are the future of banks and their soundness threatened by the rise of fintechs? And due to the fact that fintechs provide much more efficient banking services without dealing with the burden of bank regulations, the legacy burden, and standards, how is this fair? I mean, I think that's really the underlying question.
Yeah, I get that question a lot. So there are a couple of answers to that. I mean, first of all, if you're inclined to believe that these fintechs grew because of an unfair playing field, right? They were operating outside of bank regulation, and JP Morgan was operating inside of bank regulation. If you believe that, then you'd want those fintechs to come inside the bank regulatory system ASAP, right? To remedy the unfairness. They should now be subject to the same kind of safety and soundness supervision that everybody else is. So to me, that is a strong argument in favor of chartering these companies. Now, when people say, well, they pose a risk to the banking system, I guess I'm not sure what that really means. When I hear people ask that question, I think what they usually mean is it poses a risk to incumbents. That's not the same as posing a risk to the system. I mean, competitors always pose a risk to incumbents. But our job here is to unleash market forces, right? Like if customers want to get their services in a different way, it's not my job to stop them. I sometimes feel like when I get these approaches from incumbent trade associations, I sort of feel like they think I'm the taxi cab commission and I'm supposed to fend off Uber as long as I can. And you see how that worked for the taxi cab commissions. People want Uber. They want it. In a market capitalist democracy, it's not government's job to prevent them from having what they want. It's government's job to make sure that the system on which everybody's financial life is built succeeds. So I don't really buy the argument that it's risky to the system, though I get that it's risky to incumbents. I think the real risk is that we fail to accommodate them inside of the regulatory system, and then one of those giant companies fails or has a cyber hack or something while nobody was watching, then you'll see systemic risk. You want us on. I really think you do. But the rate of federally chartered banks failing is roughly half of the rate of the state money transmitters failing. It's in everybody's interest that there be a pathway for those companies to be in the federal system.
Yeah, interesting question. Interesting answer. Thank you. So, second question. Where do you go? Now we'll go back to crypto. What are your thoughts on Libra? Do you think it's going to enter the financial services market?
Well, I'm a Virgo, so I don't know why the next time over could.
Oh, Scorpio.
You look like a Scorpio. So look, on Libra, I can't comment on a particular project, obviously. I mean, Libra is one of these projects that has morphed over time. And, there was an original iteration that posed certain issues, particularly monetary policy issues in its original form. And I know that the governance structure and the nature of the product and the migration from a multi-currency crypto to a single currency crypto has changed the path. I can tell you that this is being looked at by a number of federal agencies, including ours, and we likely will have some thoughts about Libra to express publicly in the coming weeks. We don't yet. But to the extent you think Libra is a species of stablecoin, I'll just tell you what I've said before, which is I think private sector innovation around stablecoins generally is a good thing. Whether any given project is going to comply or pose money laundering risks or whatever, that's a project-specific issue. But the concept of stablecoins in the private sector, I believe, is strongly positive.
Good. Next question, go back to Project Reach. So how does Project Reach, its alternative score workstream, integrate into existing commercial efforts to expand credit access?
Well, so first of all, Project Reach is, I want to be super clear, is a commercial effort. So the OCC is not building a new credit score. What we've done is we've used our convening power to bring together people who have the ability to build a better credit score. This includes all three of the big three credit bureaus. It includes Credit Karma and Plaid and other fintechs, a number of the big banks. And the idea is to create, what you might think of as like a synthetic credit score that's roughly modeled after the main existing scores of FICO and Vantage and others. So if you could build a synthetic credit score that's using different inputs, rent, utilities, bank cash flow information, as opposed to the normal metrics, but if you could score it on the same 300 to 850 scale that the main credit scores are built on, and if you could validate that at every level they're equally predictive with the incumbent credit scores, then it's just an issue of dropping that into your credit underwriting routine when you apply for a mortgage or whatever. So that's our objective. And I think we're close to that, to be honest. I think we're weeks away from having a version 1 of this where somebody who pays their rent on time, pays their utilities on time, and has cash in the bank will have a credit score even if they don't today. And the inclusionary aspects of that are just huge. I mean, 45 million Americans who lack a credit score, we've got to fix that. And I think we're on the verge of doing so.
That's great. So this is a question I know many members of the audience have. They want you to get your crystal ball. I know President Metzler earlier said that she got hers or she did, it's in a different jacket. They want to know your forecast for when we will actually see national charters available to fintech companies.
Well, if you mean national charters available for non-depository fintech companies, my guess is you'll start seeing that next year. But if you mean for fintech companies to find a way into the banking system, the answer is yesterday. I have on my wall over here the signed charter for Borrow Bank, which is the first native fintech to get a national bank charter. We've chartered GECO, which is a group of Caltech data scientists, inventing a payments application to manage your underlying securities portfolio. We've got SoFi with a conditional approval and a number of crypto companies in the pipeline for national trust banks. So again, if all you mean is the narrow question of non-depositories, that's probably a next year thing, but it's not 2 years away. It's definitely next year. If what you mean is native fintechs finding a way into the system and finding value in it, we're already there.
So back again to crypto. People are really curious about your thinking. So the question is really about a specific issue, XRP, one particular. Is it a currency or is it a commodity?
Well, Pat, let me just begin by telling you a funny story relative to XRP. So recently I was at a car dealership in Southern California. Took a car out for a test drive. The salesman had to make a copy of my driver's license. When I came back after the test drive, the salesman was waiting on the lot with the photocopy of my driver's license. And he came over to me and he said, Mr. Brooks, I assume you want me to shred this right away because, as he said, you're a very important person. And I said, ooh, I am. No one's ever said that to me before. And he said, yes, I'm an XRP holder. So these XRP people are very passionate about their project. Look, the OCC is not engaged in the business of categorizing assets under any given set of laws. I mean, despite my title, I don't determine what currency is. I'm the guy who supervises the banking system, right? The SEC, either will or won't say whether it's XRP or its original distribution is subject to securities laws. But I can tell you this. The blockchain on which XRP is built, like all other blockchains, is a payment network. That's what blockchains are. They are internet means of transmitting value from person A to person B without any central intermediary. The XRP ledger is no different from any other blockchain. And so the XRP ledger, like other blockchains, has potential utility in the banking system. Doesn't mean that the initial distribution of XRP was or wasn't compliant with the securities laws. Doesn't mean that it is a currency, whatever that word means. But it does mean that the blockchain powered by XRP is an important payments tool like Bitcoin, like Ethereum, and other things, and needs to be taken seriously. Now, what the SEC will say about that or its initial sale, I don't know. But I do know that its ledger, like other ledgers, is important to the system. The innovation of things like that is why the United States is a leader in financial markets, and it's important for us to build an ecosystem where those underlying networks succeed. That's all I can say.
Well, look, I know we're out of time. I really appreciate your time, Brian. I mean, this has been terrific. So thank you, sir. On behalf of all the people who are online that you don't see, again, as you said, hopefully next year in Philadelphia, we'll actually see each other in 3D instead of 2D. But again, we appreciate it from the Philly Fed. Really for all your time. Thank you.
It's a real honor to be here. Thanks so much for having me, and have a great conference.
Thank you.